Hi, today from Stockholm, Sweden. In this series, History of Money, I will tell you today about a great innovator who actually introduced paper money to Europe, here in Sweden. You will find out who it was in the second part of this film. The history I am telling you about took place here on this spot in Stockholm, Sweden, next door to the Royal Palace in Stockholm. Here on this spot stood the Stockholm Banco, or Palmstruch's Bank. This was a bank created by Johan Palmstruch. Johan Palmstruch was born actually in Riga as Hans Wickmacher, son of a Dutch merchant, and he was nobled in 1651 by the Swedish crown for the service his father paid to the Swedish crown. And he was able to take on Swedish noble name Palmstruch and carry on as Johan Palmstruch from then on. And shortly after his nobility, he was able to pitch some business models to Swedish crown, to the Queen Christina, who wanted her to finance his business ideas. It was about manufacturing silk in Sweden and exporting it to Germany and Russia. Christina wasn't convinced with that business ideas, and then he was trying, so he dropped these ideas in favor of developing an idea for a Swedish bank. And he was pitching these ideas of establishing a public state bank in Sweden to Stockholm City Council twice without success. Then the right moment came in 1557. He finally convinced the new king, the new Swedish king, Carl Gustav X, to actually finance his bank, to give him money to build the bank. And the idea he had was actually two banks. The first one was, let's say, a normal exchange bank that more or less was at that time functioning in other cities, in other European cities like Amsterdam and Hamburg, and it was a bank that took deposits from people, established bank accounts for them, and the people were able to withdraw the deposits and also transfer money without the bank to other bank accounts. So it was of convenience for business, and this is what convinced also the king, because at that time there were two currencies in circulation in Sweden. There was the silver dollar and the copper dollar. And the copper dollar and the silver dollar, they were meant to have the same value. So naturally the weight of the copper dollar was many times more than the weight of the silver dollar. So it was generally copper plates that were trading. It was pretty cumbersome to trade in these copper plates, because in larger transactions, in larger business transactions, when you were transacted in full loads of ships or maybe real estate, then you needed like tons of the copper money to pay for the transaction. So it sometimes needed like you got a ship full of merchandise, and you paid for that ship for that merchandise with a ship full of money, of copper money. So it was tons and tons of money that were transacted, and even the tax collection was so difficult for the state, because it was just heavy, extremely heavy. So the cost of transport weighted a lot in the tax collection. So by establishing such a bank, the merchants could actually transact between each other by the means of bank transfer, just transferring money from one banking account to another banking account without actually needing to move that money physically. So this was the idea behind the first bank. And the second bank that he has created was the loan bank. So the loan bank was actually operating with founders' money, meaning in this case with state money or with the money of the crown, and it was lending that money against collateral, against security. So you had to give to the bank security of your real estate, maybe of some silver or golden objects. And if you didn't pay back the money, your collateral was seized and maybe auctioned, and to get back the capital for the bank. And they had pretty competitive interest on that loans, on these loans, 6%. It was below actually the market prices, but the crown wanted to make money on the assets, on the treasure they had. And this was operated by this Stockholm Banco, or Bank of Palmstruch. And what also convinced the king was that Palmstruch offered 50% of the profits from that bank to the crown, to the state. So they were two separate banks. The first bank, the exchange bank, started to become pretty popular because it was just convenient for commerce. So they started to get more and more deposits in the bank. And after a year, Johan made the first invention, the first innovation that changed the course of financial history in Europe. What he decided to do was to use the deposits from the first bank for the loans of the second bank. So it meant the second bank started to give out loans on the money it didn't possess. So that way, partial reserve banking was actually invented, because note that the money was now twice the times in circulation, because on one hand the people had the money in the bank deposits and they could transact with that money, pay for operations, whatever, by the means of transferring the money between the banking accounts. And secondly, he used the same money to give out loans in cash, and that meant that the same money was available in the open market, in free market, as cash by the people who took out the loans. So that way, partial reserve banking was invented, with all the problems that it will create. Suddenly there was much more capital to lend out, and it were competitive terms. People started to demand these loans. The market started to demand these loans more and more. And of course there were rules, the security rules, the collateral rules for the loans. But since some people were very influential in Sweden, like the nobility or some state officials, some of them got loans just with their good name as collateral, or without any collateral whatsoever. And also Johan and other maybe banking officials, they gave out loans just to become maybe friends with influential people, or become or get some benefits from people who had influence in the state, maybe people close to the king, maybe his family, and so on and so on. This way the banks run into liquidity problems, because the loans the bank gave out were long-term and the deposits were short-term deposits. So if somebody wanted to get his money he needed to get that money now immediately. He was guaranteed, by the way, that he will get the money, and the bank was bookkeeping every type of coin separately. So there was no like one currency that all the accounts were denominated in. Now, if you like deposited 10 ducats, let's say, and then 100 silver dollars and 500 copper dollars, you had in your deposit exactly these numbers of coins, and you were guaranteed to get out these coins on request. So the bank ran into liquidity problems, and then additionally copper fluctuated in price, and suddenly copper became more expensive. And since the state wanted to guarantee the same price for the copper dollar and the silver dollar, it needed to decrease the weight of the copper coin. So they were like old copper dollars and new copper dollars. And then, of course, the people who had deposited the old copper dollars, they wanted to withdraw them because the metal value was higher than the actually nominal value of the coins. So they were selling them on free market as metal and getting more dollars, like new dollars, out of that. So there was kind of a, maybe not bank run, but a high demand to withdraw the deposits in copper dollars, which lowered the liquidity of the bank even further. What do you do in such situation? You have generally several options, and the options they used were simple. First, restrict the loans. Don't give out that many loans. Second, call in the outstanding loans. So they just terminated some loans, or as many loans as they could, in order to increase the liquidity of the banks, because they operated as one bank after a while. And third thing that they did was they wanted to attract more deposits to get better liquidity. So they introduced interest on deposits. So people could get money, could get interest on the deposits in the bank. But all that wasn't enough. And now we come to Johan's second invention that actually created paper money in Europe, that started paper money in Europe. And the invention was so-called credit notes. It wasn't called banknotes yet, but it was credit notes, and it is generally paper money. What were credit notes? Johan had the idea that instead of giving or keeping people's accounts in the bank, he could actually exchange coins that people bring to the bank for credit notes, for pieces of paper with a claim to get these coins back from a bank on request. And these pieces of paper, these credit notes, they weren't tied to any given person. They were valid for the owner or for the holder of the note, and they were, and this is another invention, they had a nominal on it, and this was also a standardized nominal. So they were like, let's say, $5 credit notes, $55 credit notes, $100 credit notes, up to $1,000 credit notes, and separately for the copper dollar and for the silver dollar. And what was the consequence of that? The consequence of that was that people were able actually to transact between each other on a free market with the credit notes only, with the paper money only, without having to bring back or get the actually money, the real money, the physical money, the metal money from the bank. So they were trading between each other because the bank guaranteed that everybody could actually redeem the coins, the silver coins or the copper coins from the bank on request for the nominal that was on the note. And another thing is that it was extremely convenient because people could actually transact with that money without moving physically tons of metal. As I said in the example before, when you got a full load of merchandise, you sometimes needed to pay for that with a full load of full shipload of money. After the introduction of these credit notes, people just it was enough to send several pieces of paper, even in an envelope, even in a letter to the seller, to pay for that merchandise. It was much easier, and also the different denominations made it easy to transact in every possible amount, to put together every amount from different pieces of paper. And it wasn't known in that form before in Europe. You could argue, they had like these promissory notes in Italy before, but these promissory notes were always tied to a very specific deposit. So somebody deposited, let's say, 10 golden coins and 3 silver coins in a deposit. It was put in a drawer for him in a safe, and he got a promissory note of 10 for this specific deposit of 10 golden coins and 3 silver notes. Then he could give it to somebody else, and somebody else could pick it up. But the problem with that was that it was really difficult to transact in that, because you would need to have the exact same value of the transaction as the promissory note, because they were not denominated in standard nominals, and usually they were also tied to a person. So sometimes they weren't. Then you could transact in that, but really cumbersome. But here, this was real money that was universal, that could be used as a means of payment. They had these three characteristics. First, they were redeemable. It meant you could get the money, the copper or the silver money, the coins for them. The bank guaranteed you could redeem them, the coins for the notes at the bank. Secondly, they were transferable. You could give it to another person. It was valid for that person, for the holder of the note, to redeem that money. And thirdly, it was used as means of payment. And another smart move of him was to convince the king to accept these credit notes for tax payments. And it made sense for the crown, because then suddenly the tax collection becomes much easier. They didn't need to transport tons and tons of full carriages of money. It was enough for them to just collect the paper, and the money, the metal, was brought by the depositors to the bank by themselves. This was one thing. And the other thing was, it became also attractive to general public, because they now could pay their taxes also in this paper money without the cumbersome use of copper that weighed so much. So there was a big demand for that. And after a while, people realized that they actually didn't need to withdraw the money from the bank, because there was no need for using the cash in the understanding of these times, meaning the coins, the metal coins, because they could transact in that paper money that everybody accepted, at least in Sweden, and there was no need to redeem the money from the bank. And that propelled again the company of Johan Palmstruch, the Stockholm Banco. Why? Because now most limitations for the credit action of that bank was lifted. The credit notes became so popular that people brought more and more metal, more and more coins to the bank in exchange for the credit notes. And they didn't need, or they didn't get any accounts at the bank for that. It was just exchange money for the note, metal coins for paper, and the bank was just there sitting on stash of coins, of metal coins, of silver and copper coins, big amounts of coins, up to $400,000 dollars in of these coins, without having them actually on the balance sheet, without having them in the accounts of the customers. They just had an obligation against the general public to redeem that money for the notes that it has given out. But on the other hand, it could use all that money for the credit action. So it raised the amounts of money available for credit, for loans, exponentially, in big way. And Johan, of course, used that money to give out as many loans as possible, and the bank used that possibility to access. And at some point, Johan was informed by one of his employees, by the general manager, that they had only $4,000 in the bank, but one of the depositors wanted to withdraw $10,000. At that point, it was clear they are generally insolvent, and what they needed to do is to somehow restrict the possibility for people to withdraw the money. So what they did, they established, actually from the beginning on, there were different opening hours for the people who deposited money and for the people who wanted to withdraw the money. So what they did was they started to restrict the hours and the access to withdrawing money. So sometimes the bank was just closed in the afternoon when people wanted to withdraw money, but it was open in the morning when people were depositing money. So then, as soon as they had money in the deposit again, they were opening the withdrawals, people could withdraw, and so on and so on. But this action caused loss of confidence in the ability of bank to actually redeem the paper money. And the result of that was that the value of paper money, of the credit notes, was less than the nominal on these notes. Meaning, if you had to buy something for $100 in silver money or in copper money, they required you to pay 8% up to 10% premium if you paid it with these credit notes, with the paper money. So you had to pay the nominal of $108, $110 in paper money. And that had, again, a catastrophic effect on the bank, because this meant that some people could make profit just by buying these credit notes in the open market, bringing them to the bank, because officially they had guaranteed that they could redeem it. It was guaranteed by the bank, so they were bringing the notes to the bank and getting for them the money again. I mean the nominal amount of coins. Let's say you had $100 in silver. You could buy $110 in paper money, in the credit notes, bring it to the bank, and get from the bank $110 in silver money. So you made a 10% profit in just maybe one day or two days. So more and more people started to do that. So more and more people were crowding the bank and trying to get out the deposits, to drain the bank, because it was just profitable for them. So it made the bank run even stronger, and Sweden experienced for the first time in its history monetary inflation. So what did the bank started to do? They started to behave like in an open market. they started to, let's say, default on the obligation to actually redeem the nominal amount of money on the credit note, and also use the premium that market used. They would say, okay, you want to get $100 silver dollars, you need to bring a note or $110 in these credit notes, in the paper money, to get 100 silver dollars. And people started to rebel against that. Meanwhile, the king died, and the royal council decided that the bank should terminate all loans that it has given out in order to increase its liquidity and be able to pay for its obligations to the people, to the depositors. So Johan was forced to terminate all loans, and with all the consequences to the business. People went bankrupt because, of course, people got out loans with collateral to invest in their businesses and so on and so on. And they were paying their interest, they were serving these loans, but then suddenly the bank terminates the loan and you are unable to pay back the full principal. That's why you took out the loan, right? So businesses of many people got wrecked, they went bankrupt. It caused economic crisis, but the liquidity of the bank went up, and then the Royal Council again made an order to pay out all depositors of the credit notes the deposits, meaning to call in all credit notes and to pay out deposits, the nominals on the credit notes. So what the bank tried to do, at the end it turned out several $10,000s of dollars were missing in the bank. Either they gave out too many credit notes, or somebody was stealing from the bank the coins, the silver and the copper coins. Of course, there was a commission, and the commission set up or found out these irregularities, and Johan was sentenced to lose all his privileges as a nobleman and to pay back to the crown the amount of money that was lost in the bank, that was identified as missing. It was many thousands of dollars, and Johan didn't have that money. And if he didn't pay that money in 6 months, he would be executed to death, right? He would be executed. He wasn't able to pay back the money. But fortunately, the city council or the judge decided to change the sentence to a prison sentence, and he was imprisoned. But one of his debtors, and he was very influential in the kingdom, he was the admiral of the Swedish army, one of the most powerful people in Sweden at that time. He intervened and he made it possible that Johan was released. Unfortunately, 1 year later, Johan died. But this is the history of money in Europe. Johan made two major innovations in the history of money, in the history of banking. First was to use the deposit money for lending, and the second was to introduce something like a banknote, a credit note that was transferable, that had a nominal, that was able to be used as means of money. It was the first paper money in Europe. And all that happened here, just behind me, where his bank stood at that time in the 17th century. But after all, Stockholm Banco wasn't a central bank. It was a precursor of a central bank that was called Riksbank, Sverige Riksbank here in Sweden, and it was also the first central bank in Europe. It was established several years later, and 200 years later, a new building of the Riksbank was erected just here opposite of the old Stockholm Banco, together with the Swedish Parliament. So this is Swedish Parliament, and here next to the Swedish Parliament they built the Riksbank, meaning the central Swedish bank. Today it is used as a parliament building as well, but for a long time it was used as a central bank of Sweden. Sweden is a great innovator in the history of banking, in the history of money, and that's what I will be talking about in my next video in this series. If you like this video, give me a thumb up. If not, of course, thumb down. Subscribe if you haven't. Share this video with your loved ones, with your friends. One day they will thank you for that. I talk here a lot about money, about business, about economy, about how the best entrepreneurs in our times, how the self-made billionaires think and act. So if you like this video, you will certainly like my other videos. I invite you to watch them. That's it for today from Stockholm, Sweden. I wish you a fantastic day. Let's do something extraordinary today.